This is The Chris Berry Show. Expert information on elder law, retirement, and estate planning. Information that you can understand. Here's your host, Chris Berry.
Welcome to The Chris Berry Show. This is Chris Berry, where we talk wealth, estate, and tax planning for the second half of life. And we always like to start off The Chris Berry Show with a positive focus, something positive that's happened in the previous week. And so for me, this past week, it's been a fun week. The most exciting thing was weekend, actually prior to 4th of July. It was super hot outside all weekend, but it was a great weekend. I spent it on the lake, grilling and spending it with family. Just enjoyed playing on the lake. Tried out a stand-up paddleboard. My wife purchased a couple stand-up paddleboards earlier this summer, and this was the first time I actually got to try it. She had a chance to try it a couple times, and wow, is it difficult. I'm pretty tall. I'm 6'5", so it's kind of circus freak tall, so I blame my tall center of gravity. And it was kind of fun trying the stand-up paddleboard again, because the first time I tried it was actually my wife and I I think probably our third date. I'd purchased a Groupon where we were able to get a sunset tour along with a couple others guided around Walled Lake. And so that was the first time trying to stand up paddleboard. And I don't think she fell in at all when she did it, but I must have fallen in about 25 times. So it wasn't so much stand-up paddleboarding. It was more Chris climbing out of the water to try to climb back on the paddleboard. And it was pretty embarrassing, but she stuck with me, and I'm getting back to the stand-up paddleboard. So it was pretty good to be able to break it out this weekend, have some time to do that, while also taking advantage of the chance to use my new grill. Purchased one of those Traeger pellet grills a couple weeks ago, and so Saturday I was able to make a delightful recipe using some cherry wood for the smoking and made some ribs. And then Sunday, I was able to make a delicious steak. So I'm breaking in my grill, able to play on the lake, enjoying the weather. Felt very 4th of July, even though it wasn't the actual 4th of July. So that was pretty exciting. Really enjoyed that. And also, we got a chance to play some bagos, or maybe you call it cornhole, where you get bean bags and you throw it about 15 feet into this board. And if it gets in the hole, you score more points. If it lands on the board, you get a couple points. So I was able to break those out. Haven't played that in probably a couple of years. Used to play that a lot, but it was interesting. And kind of my strategy was to kind of start with a throw, and then slowly as you get it more honed in, you kind of tweak your throwing approach. And it's kind of similar to financial planning, as you put together a plan, and as you get closer, you kind of tweak it along the way. So it was good to do that. So really enjoyed that 4th of July. So I had a great 4th of July week. But unfortunately, one of my friends contacted me this week, and he was involved in a boating accident. He's okay. The other family is okay, but he called me and was talking to me about potential liability. And so we had previously met and talked about estate planning and setting up a trust and setting up an asset protection trust. But he hadn't moved forward with that. He was busy with work. And then all of a sudden, I got a message from him saying, "Hey, can we come in and finish up that estate plan right away?" And I was like, "Sure, what's the rush?" And he told me about the boating accident, and he was concerned about liability. And so unfortunately, once you have some type of event like that where you might be sued or there might be potential liability, it might be a little late to set up an asset protection trust or take on strategies to try to protect or preserve your assets. Because of this concept, it's called fraudulent conveyance. Basically, once an event happens or you think you're going to be liable for something, then if you were to make a transfer or set up an asset protection trust like a castle trust, or try to maneuver your assets from an asset protection standpoint, most likely the courts would deem that a fraudulent transfer, and they're going to go back and try to trap or get access to those assets. So a lot of times at that point it might be too late. So in this situation, he's just going to have to rely on what he already has in place. And luckily, I asked him, he does have a umbrella policy, a liability policy that covers basically any type of potential events where you might get sued. And typically it covers up to maybe $1 million. And it's relatively inexpensive to set up an umbrella policy. It might be $300-400 a year for that umbrella policy for maybe $1 million. So in this situation, he does have an umbrella policy, so that's going to be helpful for him. But it brings home the fact that had we set things up ahead of time, if he had moved forward with that asset protection trust, in our office we call it a castle trust, if he had moved forward and set up that castle trust, then any assets that he had inside of the castle trust would be protected from any potential lawsuits. So while it's not good that he was involved in this boating accident, but if his assets had been in the castle trust, then most likely that would have been a wall that would have stopped any type of creditors or lawsuits trying to attach to his assets. In a castle trust, it's very different than your typical revocable or living trust or basic living trust. With the revocable living trust, what it can do is it can avoid probate and control your distribution upon death. And if you remember a couple episodes back, we talked about why it's important to avoid probate, because it's costly and it's time-consuming. So your revocable living trust can avoid probate and control the distribution upon your death. But what the revocable living trust or your basic living trust misses out on is that asset protection. And too often when we think of asset protection, a lot of times people assume it's just long-term care costs, where if the assets are held in trust, a castle trust for over 5 years, then all the assets would be protected from that nursing home or Medicaid spend down. But an asset protection trust can not only protect against long-term care costs, but also it can protect against liabilities such as lawsuits, such as this situation. So the castle trust is a type of trust that appeals to a lot of my clients, a lot of clients who maybe own a business, or clients who just want to protect their assets from life happening. Because my friend, he didn't plan on getting in a boat accident, but it happened. And luckily, everyone was okay, but he is concerned about potential liability for this action. And so the earlier you start thinking about these types of plans or these things that could pop up in your life, the more options we have on the table. And generally, the better the potential outcomes, the earlier you start thinking about this type of planning. So luckily, he did have an umbrella policy. So if it does come to a lawsuit of him getting sued, that umbrella policy will cover up to whatever limits he purchased. But if he had planned ahead or went forward with the asset protection planning moving forward, then that umbrella policy, it's basically just building sandbags. You're just building up a certain level of protection. Versus if it was in the castle trust, then he would have built a wall around his assets. So it's important to understand that earlier you start thinking about this type of planning, the more options you're going to have on the table, and the better those potential options. And that applies to a lot of things when it comes to planning. So not only does it apply to protecting against lawsuits, where now if he were to move those assets into the castle trust, he'd have a fraudulent conveyance issue. But also we see this come into play a lot of times with regards to long-term care planning. For example, a lot of clients will attend one of our weekly workshops and maybe they're planning for themselves or they're planning for a loved one. But if that loved one already has some pre-existing conditions, then there's certain options that just fall off the table, meaning they're not a possibility anymore. For example, if you have pre-existing conditions, a lot of times certain types of long-term care insurance you would not be able to be approved for. This is especially true with pure traditional long-term care insurance. And if you remember, we've talked about long-term care insurance, and there's two types of long-term care insurance. There's the pure traditional long-term care insurance, where if you don't use it, you end up losing it, and there can be increasing premiums on you. So we try to stay away from that pure traditional long-term care insurance, where now we look at that asset-based long-term care insurance. And one of the nice things about the asset-based long-term care insurance is that the underwriting is less stringent. For example, even in my situation, if I were to need or want pure traditional long-term care insurance, chances are I might not be able to qualify for it because I need a knee replacement, which they don't really do for people my age. But the years of basketball were not kind to my knees. So because of this knee replacement that is in my medical file, the cost of pure traditional long-term care insurance might be prohibitive, or it might not even be able to qualify. So again, this idea of kind of planning ahead, having a plan in place before something happens, comes into play a lot of times, whether we're talking about lawsuit protection, say you're involved in a boating accident, or if you're considering long-term care insurance. The earlier you start thinking about it, typically the better chance you're going to have. Or likewise with life insurance. If you're considering getting life insurance, kind of the younger you are, the healthier you are, the better that premium may be. Or if you're concerned about long-term care costs for a loved one who might be already marching down that elder care journey. For example, if you're concerned about nursing home costs, which could easily be $8,000 to $12,000 a month, then you want to start thinking about protecting against that sooner rather than later. Because with nursing home costs, we have this governmental program called Medicaid that'll help pay for that cost of care. But Medicaid has an asset test where a single individual can only have $2,000 worth of accountable assets. And a married couple, they can make you cut your assets in half. At most, you can have $120,000. So to protect against that nursing home or Medicaid spend down, one of the best strategies where we can protect 100% of the assets is to rely on that 5-year look-back period, try to beat that clock. Because Medicaid looks back 5 years to see if you moved any money around. And if you've moved money around, they're going to penalize you. So if we're planning ahead, thinking about the potential threats or concerns before they happen, then one of the strategies might be to set up a castle trust, move our assets into that trust, and then if we can make it 5 years, everything inside of that trust would be protected from that nursing home or Medicaid spend down. Again, it's all about planning ahead. There's still things we can do in a crisis situation, but in all of these different scenarios, you see that by planning ahead, you're going to have more options that are available to you and better potential outcomes. And so that's why on the Chris Berry Show, we talk about wealth, estate, and tax planning for the second half of life. And if you notice, we include the word planning, meaning planning ahead. We don't know what life's going to throw at us, whether we're going to need long-term care costs in a nursing home, whether the market is going to go up or down, or whether we're going to be involved in a boating accident. But we need to be aware of these threats and take steps to try to protect ourselves from the things that we're concerned about. That's why when we're meeting with clients, one of the things when we're talking about estate planning is we walk through a tool called an estate planning audit, where we figure out where exactly you are, but then figure out the things that you're concerned about. Are you concerned about long-term care costs? Are you concerned about probate? Are you concerned about sequence of returns risk, or whether the market's going to go up or down at the wrong time? These are all things that I can't tell you whether they're important to you or not. You have to identify whether they're important. And then we'll take steps and apply strategies to try to protect you against those things that you're concerned about, to make sure that you can sleep better at night. So if you want more information on the things that maybe you should look at protecting yourself from, to put together a plan, then please visit our website at thechrisberryshow.com. There's some free resources available there if you click around a little bit. And then also you can sign up to attend one of our free weekly workshops at one of our offices throughout Metro Detroit. And we have offices in Bloomfield Hills, Novi, Livonia, as well as Brighton. And typically we're doing one of our free educational workshops on protecting for the second half of life at one of our office locations about once a week. And if you want more information on that, again, you can visit our website at thechrisberryshow.com. And also feel free to shoot us an email if you want a list of our upcoming workshops. You can shoot us an email anytime at askchris@thechrisberryshow.com. And you've been listening to The Chris Berry Show with, of course, Chris Berry on FM 101.5, AM 1400, The Patriot. And you can also subscribe via iTunes to our podcast. And in our next segment, what we're going to talk about planning, but we're going to talk about tax planning, and more specifically, some of the changes that have happened with this new tax plan that we're under with Donald Trump, his new plan. So we're going to talk about some opportunities there and developing a plan for taxes. It's one thing to prepare taxes. That's just doing the reporting. That's looking back. But what we're going to talk about is actual tax planning. And we talked a little bit about this with regards to IRAs, and we'll talk more about that in the next segment. But we'll also talk about the tax changes that have happened in 2018. So stick with us on the next segment. And then our third segment today, as always, we're going to answer our listeners' questions. So every week, what I do is I gather up a list of the questions that have been submitted either via email or via phone. And I pick a few of those questions to answer over the air because we're all about providing education. So if you do have a question that you want us to take a look at and maybe answer on air, please shoot us an email at askchris@thechrisberryshow.com or give us a call, leave a message at 810-355-2584. Again, 810-355-2584. Or email us at askchris@thechrisberryshow.com. And again, join us next segment as we talk tax planning for the second half of life, and we talk about changes in the tax rules and specific strategies that you should consider due to these new changes. Some of these changes are positive, some of them are negative, but we're going to talk about the different changes and how it applies maybe to your situation. So join us after the break. I look forward to seeing you there.
If you or a loved one is facing long-term care costs, make sure you talk with certified elder law attorney Chris Berry from the Elder Care Firm. Here's Elder Care Firm client Bill Dappridge.
My wife has dementia. We decided that we had to put her in the nursing home. Well, naturally, we had to get lawyers, and we went through 3 before we met Mr. Berry. He's done everything for us. I guess one of those things that kind of sticks in your mind, he says, "I'm your new best friend," which is true. He's really helped a lot. One of my biggest concerns was not to have to sell the house up north because actually I wouldn't get a penny out of it. It would all went to the state or the nursing home. And Chris says, "Don't worry about it. We'll take care of that." Would I recommend him? Definitely, especially the people there in Brighton. They've been great.
Hello, I'm attorney Chris Berry. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Protect your assets from probate, long-term care costs, the IRS, and get the governmental benefits you deserve. Visit theeldercarefirm.com today or call 810-214-3800.
Welcome back to the Chris Berry Show, where we talk wealth, estate, and tax planning for the second half of life. And so this segment, we're going to get into tax changes and some of the key tax changes from the Tax Cuts and Jobs Act, which has recently passed. So this is our new tax code. And we're going to talk about some of the key changes, and then we're going to talk about some of the effects it has as you're moving into retirement, or maybe you're already retired, or even if you're not retired, some of the effects that this new law has, and then some opportunities for you as well, specifically with those tax-deferred accounts, those IRAs, those 401ks. So this is one of those areas where you can't change the rules, but you can develop a plan based on what those rules are. So just like you can't control what the market's going to do on any given day, you can have a plan. Likewise, you can't change the tax laws or the tax code, but you can have a plan based on what the rules are. So we're going to look at some of the old laws and new laws with regards to these key tax changes. So the first thing, and probably the most important thing to understand, is the change in the income tax brackets. So the old law, we had 7 brackets starting as low as 10%, going all the way up to 39.6%. And the interesting thing is that already that was a historically low tax rate. For example, if you've ever heard of Ronald Reagan, what was he before he was a politician? He was an actor. And when he was an actor, the highest marginal tax rate, take a second to guess, was 94%. 94%, meaning if he made 2 movies in a year, made over $200,000, then 94% of his income would go, or he'd reach that 94% income tax bracket. And do you know where the other 6% would go? Some people say Nancy, but to the state of California. So effectively, if he made any more money, 100% of that money would go to the government. So with our old tax law maxing out at 39.6%, that was thought to be a historically low marginal tax rate. So what is the new law? What's the new change? Well, we still have 7 tax brackets, but now it starts again at 10% and then goes up to 12, to 22, 24, 32, maxing out at 37%. So basically across the board, marginal tax rates have been lowered. So some things to think about, take a look at what's your paycheck withholdings. Maybe now is a time to look, because marginal tax rates are lowered, maybe now is a time that if you do have pre-tax dollars, money in IRAs or 401ks, maybe it makes sense to pay the tax now versus later. Because the way the law is written is the marginal tax rates are scheduled to go up. And then what happens if we get the other party into the presidency? Will they keep the tax code? Will they make changes? So I think you have a unique opportunity right now to look to either maybe pay more tax now so you don't have to pay the tax later, or at least look at what your paycheck withholdings are if you're continuing to work. So that's the biggest change and probably the most important change. Then we had a change with regards to your standard deduction. So the old law was that you had a $6,350 standard deduction if you're single, and then now it's and then if you're married, it was $12,700 if you're married filing jointly. Well, now what's happened is the personal exemption is eliminated, and you get a standard deduction for a single individual of $12,000, and married filing jointly is $24,000. So it's a little bit more straightforward there. Now, the alternative minimum tax, that hardly affects any people. The changes they made there makes it so that even less people will be taxed. Now let's look at medical expenses, and this was something that was they were fighting about till the very last minute, and we weren't quite sure what was going to happen with your medical expenses and how you can write those off. And so with the medical expenses, the old law was that you could deduct expenses that exceeded 10% of your adjusted gross income. So anything over 10% of your AGI you could deduct. Now with the new tax law, you can deduct anything that exceeds 7.5% of your AGI. So what that means is at least this year you can deduct more, and then actually next year, 2019, it's going back to that 10%. That 10% level. So this year might be the year that if you have to take a lot of medical expenses, you take more medical expenses this year than you do last year or next year. Then let's look at charitable giving. So in the past, charitable giving could only be deducted up to 50% of your adjusted gross income. Now cash contributions can be deducted up to 60% of your adjusted gross income. So one of the things here is charitable contributions are expected to decrease as a result of fewer people itemizing those deductions. So that's something unfortunate. It's going to maybe have an effect on charities. But from a planning standpoint, one thing to take into account might be if you're looking at doing any type of charitable giving, trying to bunch it up in specific years to get it all in 1 year. So something to think about with regards to charitable giving to churches, nonprofits, charities, that type of thing. Now let's look at a mortgage interest. So the old law was you could deduct interest on mortgage debt up to $1 million, and you could deduct the interest on up to $100,000 of home equity loans. Now, the new law is you can deduct interest on mortgage debt up to $750,000, and home equity loan interest is not deductible unless used in connection with home acquisitions or home improvements. So what this means is increased home ownership costs need to be considered potentially when buying a home. So we're not able to write off as much in that situation. Now, let's look at the child tax credit. So this was the child tax credit. So the old law, you received a credit of $1,000, only partially refundable and phased out if you were earning a certain level. $75,000 if you're single, $110,000 if you're married filing jointly. The new law is that you receive a credit of $2,000 per child. $1,400 of that is refundable, and that phases out at $200,000 for a single individual, $400,000 for married filing jointly. And this applies to children 17 or younger at the end of the year, a $500 credit for other dependents. Now let's look at the kiddie tax. So earnings on a child's investment income over $2,100 was taxed at their parents' tax rate. So the idea behind the kiddie tax is you don't put assets into your kids' names thinking that, if it grows, it's going to be taxed at a lower amount. Now the new rule, earnings on a child's investment income over $2,100 will be taxed at the same rates as trust and estates. And this tax applies to investment income of children under age 19 or 24 if full-time students. And the thing with this is that instead of being under the parents' rates, they switched over the trust and estate tax marginal tax rates. And they have a different, they're at different rates where they get to a higher level very quickly and when you're taxed at the trust or estate level. Let's look at 529 plans, interesting change here. So the old law, distributions only allowed for post-secondary education. With this new law, you can distribute $10,000 per year for private K through 12 education. So if you have your young children in private school, then the 529 can be utilized for that. And you can also roll over 529s to an ENABLE account if you do have a child with special needs. Now let's look at alimony. So alimony was tax deductible for the payer and taxed as income for the payee. New law, alimony is no longer deductible for the payee, nor is it considered income for the payee. And this applies to agreements executed after 2018. So this is new moving forward. If you have an agreement that was executed prior, you have to follow the old rules. Now let's look at Roth IRAs. So under the old law, you could reverse a Roth conversion by a tax due date. So basically, you could do a do-over if you decided to change your mind. We call those recharacterizations. Well, under the new law, recharacterizations are not allowed. And so what that means is that if you're considering a Roth conversion, and right now might be the time to do that with the lower marginal tax rates, you'll have to plan very carefully. And so that's one of the things that we do in our office is we help our clients with these Roth conversions by putting together a tax map to figure out just how much we should convert on any given year to look at not only how does it affect the marginal tax rate, but also how does it affect the effective tax rate, the overall tax that you pay. Now let's look at retirement plans. So the old law, participants in a 401k or 403b had 60 days to repay or roll over a plan loan upon leaving the firm. Under the new law, participants in a 401k or 403b have until the tax due date to repay a rollover or a plan loan upon leaving the firm. And then if the loan is not rolled over or repaid, it can go into default, triggering penalties and taxes. Now let's look at the estate tax exemption or the inheritance tax or the death tax. And so with this tax, you're probably familiar with income tax. You're taxed as you make money. Well, with estate tax, you're taxed when you die. So the government takes another swipe of your assets. So under the old law, the top rate was 40%, meaning that the government could take 40% of your estate. And this would be for estates over, it was to be $5.6 million for individuals, or if you're married, $11.2 million. So in all honesty, that's not going to affect a lot of people, meaning if you pass away with less than $5.6 million as an individual, you owe zero tax. Now under the new law, the top tax rate of 40% is still in place, but that exemption or that coupon amount is $11.2 million for an individual or $22.4 million for married couples. Meaning if you're a married couple and if you die with less than $22.4 million, you don't owe any estate tax. And if you have more than that, that's a good problem to have. There's still things you can do. But for a majority of individuals, the estate tax really isn't going to be affecting them. In fact, only 8 out of 1,000 estates are expected to owe any federal estate taxes in 2018. So very small number of people will this estate tax affect. And most likely the estate tax will probably go away at some point. Don't quote me on that. But in this previous election, the Democrats ran on a platform of keeping the estate tax where it was, meaning they didn't want to lower it back to earlier levels because the estate tax used to be at $600,000. And then the Republicans ran on a platform of eliminating the estate tax entirely. So my view is that the estate tax is probably going to go away entirely in the future. Because also one of the reasons I think that is that in reality, the government is not the one that makes out when there's lower estate tax exemptions. Typically what happens is that people look at it as, do I want to leave money to the government or do I want to leave the money to a charity? And the money you leave to a charity as part of your estate plan, that would lower or not count for estate tax purposes. So if it's a matter of leaving money to Uncle Sam or leaving it to your favorite church, charity, or nonprofit, most people chose the nonprofit route or the church or the charity. So in reality, the estate tax really wasn't a moneymaker for the government. So personally, I don't think the estate tax is going to come into play. But if you are one of those individuals with $22.4 million or more, then you have to do some planning, and hopefully you've taken that into account, and you have some good professionals helping you with that. Now let's look at corporate tax rates. So for corporations, the top tax rate was 39%. Now with this new law, the top tax rate is 21%. So a strong reduction there. Pass-through income. So small business owners paid income taxes based on the rate for individuals up to that 39.6%. That was the old rule. The new rule, small business owners receive a 20% deduction for pass-through business income. Then with regards to expensing, you could expense $500,000 of business assets. That was the old rule. The new rule is you can expense $1 million of business assets. So with a new tax plan, it's a little bit more favorable for the business owners. So hopefully that was helpful. One of the biggest strategies is just looking at ways to maybe pay the tax now versus later. Maybe look at Roth conversions because you'd rather be taxed on the seed versus the harvest, especially in this lower marginal tax rate environment that we're currently in. And if you want to learn more or have us prepare a tax map for you, take a look at our website at thechrisberryshow.com. Feel free to shoot us an email if you do have any questions. Some of those questions we'll read on air, and that'll be in our next segment. Shoot us an email at askchris@thechrisberryshow.com. And you've been listening to The Chris Berry Show on FM 101.5 AM 1400, The Patriot, as well as where podcasts live on iTunes. You can also download iTunes at our website at thechrisberryshow.com. And join us in our next segment where we talk answers to some of your questions. Join us after the break. Thank you.
The cost of long-term care can be overwhelming. If you're dealing with long-term care costs, make plans to attend the next free informative workshop from the Elder Care Firm in Brighton. They'll show you how to protect your hard-earned assets and obtain the governmental benefits you deserve, including veterans benefits and Medicaid.
Hello, I'm attorney Chris Berry. As the only certified elder law attorney in Livingston County, I have the knowledge and estate planning strategies to help you. When you call, reserve your seat at our next workshop or schedule a free 15-minute phone consultation. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Spots are filling up for the next free Elder Care Firm workshop. Reserve your seat today by calling 810-214-3800 or visit theeldercarefirm.com. The Elder Care Firm also invites you to join them for Excite Night at the Pound in downtown Brighton on Tuesday night, August 9th from 5 to 7. This is the kickoff event for this year's Walk to End Alzheimer's, coming up on October 1st. Call 810-214-3800 today.
And welcome back to the Chris Berry Show. This is Chris Berry, where we talk wealth, estate, and tax planning. And last segment, we talked about the changes in taxes with this new tax code. One of the biggest strategies, and I want to stress this again, is just looking at how much tax I'm paying right now. What is my marginal tax rate? Do I have more room before I go up to that next tax bracket to maybe look at paying the income tax, especially on those pre-tax accounts? So if you do have a 401k or if you have an IRA, that money is pre-tax money, meaning you haven't paid income tax on it yet. Well, with this new tax code, with these lower marginal tax rates, basically taxes are on sale right now. Let's take an example. Let's say you have $300,000 in your IRA, and maybe you have a tax burden of $100,000. That would be your tax. Kind of view that as a mortgage. Well, guess what? It's an adjustable rate mortgage, and the government is nice enough to lower that mortgage for you, lower that tax rate for you. So it might make sense to take money from those tax-deferred accounts to look at doing things like Roth conversions, or at least getting out of that partnership with the IRS, with the Internal Revenue Service. Look at ways to defer, as Ed Slott calls it, the retirement savings time bomb of those taxes. Because what happens when you turn 70 and a half? Well, at age 70, if you haven't already, you have to start taking your Social Security. But then at 70 and a half, you have to start taking money out of those tax-deferred accounts, taking money out of those IRAs and 401ks. And you're locked into that. Well, before you reach that age, it might make sense, or explore at least, the idea of paying the taxes sooner rather than later, especially given these recent tax cuts that we've had. And if you want more information on one of those strategies, I recommend attending one of our workshops. We talk about this basically weekly. And you can register for the workshop or find out a list of when those workshops are and when we're going to be in your city by going to thechrisberryshow.com, or give us a call at 810-355-2584, and we can send you some information on that. And then in this segment, we're going to get into some of the questions and answers from some of our listeners. Some of the questions, and I'll provide some of the answers. So the first one is from Claire. And Claire asks, can a durable power of attorney override a healthcare power of attorney? And so she says, I have a healthcare power of attorney to care for my boyfriend. His cousin has a durable power of attorney, and he's currently incapacitated, and his cousin needs a letter from the doctors indicating he is incapacitated so that the durable power of attorney can take effect. Will this void my healthcare power of attorney? So there's a little bit to this question. It sounds like Claire has a healthcare or a medical power of attorney for her boyfriend, and her boyfriend's cousin has the financial power of attorney. So in reality, these are two different documents. One is to make financial make financial decisions, so to be able to write checks, pay bills, that type of thing. And it sounds like that financial power of attorney is what's called a springing financial power of attorney versus an immediate financial power of attorney. And then Claire, she has that separate power of attorney called a medical power of attorney. So one document makes medical decisions, the other one makes financial decisions. So with the financial power of attorney, there's really two types that we have. One is called a springing financial power of attorney. The other is an immediate financial power of attorney. So it sounds like Claire's boyfriend has a springing financial power of attorney, meaning it springs into effect once two licensed physicians sign off to say that her boyfriend is incapacitated. So that's why the cousin is asking for those physician's letters, because the cousin needs that to be able to take action, to be able to pay bills or get anything done on behalf of the boyfriend. Now you compare that to an immediate financial power of attorney, and that's one that's effective immediately, meaning once you sign it, the person you've appointed has the ability to make financial decisions for you. And typically in our office, we do the immediate financial powers of attorney, a lot of times appointing a spouse as that person. If not the spouse, then maybe the children or a loved one. And the reason we do that is, A, the person you've appointed, they owe you a fiduciary duty to act on your behalf. And also, they're someone that you trust, because otherwise you wouldn't appoint them to serve that role. And because they owe that fiduciary duty, they can't just take your money from you. And the reason we like that immediate power of attorney versus the springing is because of this specific issue. The cousin might have to get things done right now for the boyfriend, but they have to jump through these hoops of getting 2 licensed physicians to sign off on something. And trying to get 2 licensed physicians in a room together, it's like wrangling squirrels. It can make it more difficult. So a lot of times we do the immediate financial power of attorney versus this springing financial power of attorney. But to get back to the specific question, will this step void my healthcare power of attorney? The answer to that is no, Claire, because it's a separate document. You still have medical authority. This is giving the cousin financial authority. So hopefully that was helpful, Claire. Now to the next question. So the question is, how does a will work when someone passes away? And this is from Charles. My dad recently passed away and made up a will for my siblings and I. Well, Charles, I'm sorry for your loss, but to answer your question, how does a will work? Well, we need to understand that a will is a tool and it fits a specific purpose. And before I can explain what a will does, you need to see how it fits into the overall role of estate administration. And we've talked about this on previous episodes, but estate administration, the way it works, and this is the process of getting someone's assets out of their name when they pass away, it's really a 4-pronged approach, where if it doesn't pass through one of the first 3 ways, then it ends up going into probate. So the first way that an asset might transfer out of someone's name upon death is through joint ownership. So Charles, if you're married and you have a joint bank account with your wife, if you were to pass away, Charles, then that bank account goes to your wife. The second way would be through beneficiary designations. So, Charles, if you have a checking account or let's say a life insurance policy and you've passed away, that life insurance goes to whoever you've named as a beneficiary. So that's beneficiary designations. Third, we have trusts. And there's a variety of different types of trusts that are available, but think of a trust kind of like a suitcase. You put things into that suitcase, and then when you pass away, you pass that suitcase on to someone else to administer for the beneficiaries. So if it's in trust, it obviously avoids probate. But if an asset doesn't pass through joint ownership, beneficiary designation, trust, then it ends up going into probate. And that's what we want to try to avoid, because it's a court process, it's time-consuming, and it's public. Anyone can see what's going through the probate process. So what did I not mention? I didn't mention a will. A lot of people think a will avoids probate. However, it does not. What a will does is gives instruction to the probate court on how to administer your estate. Because when assets end up in probate, there's 2 options. One, you die intestate without a will, and we follow the default rules of Michigan. Or you do have a will, meaning you die testate. And you still have to go through the probate process, but now the probate court is going to follow the instructions that were written up in the will. So who serves as personal representative? Where do the assets go? So hopefully, when your dad passed away, the assets passed through a way other than probate. But if the assets do end up in probate, Charles, that's when that will kicks in, that last will and testament. So that will gives instructions to probate court on how to administer the estate. So you have to file that will with the probate court after you petition the court to open up an estate. And hopefully it's a simple, uncontested probate, but it's still going to be a 5-month process where you have to pay filing fees, inventory fees, publication fees, and it has to stay open for at least 5 months, even if you do have a will. So a lot of times we look at other ways to pass assets to avoid probate, because again, a will basically is your ticket to the probate court, and most people want to try to avoid probate. So I hope that was helpful for you, Charles. Now our third question of the week, and this is from Amy. My father passed away a few years ago. He had a living trust, and his house was in the trust. And then Amy writes, my brother and I were both trustees. I had removed myself for my own reasons. And we see that the family dynamics can always be pretty interesting. I already bought my brother out. I just need to know what I have to do to get the house in my name and my husband's name. So it sounds like Amy's father passed away a couple years ago. There was a trust in place, so it sounds like everything avoided probate the way it should. And now they're wrapping up the trust, and it looks like Amy bought out her brother, so she should be the owner of the house. But now we want to make sure that legally she is the owner. So what needs to happen? Well, what I would recommend, or probably what should happen here, is that the trust most likely says that the house is to go to you and your brother. So whoever the trustee is, and it sounds like your brother, should do a deed, deeding the property from the trust to you, Amy, as well as your brother jointly. So it's in both of your names now. And your brother is the trustee. He'd be responsible for doing that. And he might need a certificate of trust, a document that says he's the trustee. And so you would file a deed along with a certificate of trust at the Register of Deeds in whatever county your father lived in. So now it's in your name and your brother's name outright. Now, if your brother has agreed to give you the house for money, then what you need to do is do another deed where your brother and you deed the property. So both of you sign off on this. What you do is you deed it to yourself, Amy, as well as your husband. And you would say his husband and wife. So it's kind of a two-step process. Two sets of deeds would have to be signed. So the first deed would be taking it from the trust, putting it into your name and your brother's name, because that's what the trust says. You have to honor what the trust says. You have to follow Dad's wishes. And then from there, you give money to your brother, and then your brother then agrees to sign the deed along with yourself. So both of you would be the legal term is grantors, the person doing the deed, and then the grantees, the person receiving the deed, would be Amy, yourself, and then your husband. And then once that's done, and again, that would be recorded at the Register of Deeds. Once that's done, then the house would be both yours and your husband's. And then the next step I would take, and this isn't part of your question, but it's just good planning, would be to think about your own plan, your own estate plan if you don't have one. For example, if you have a trust, if you have an asset protection trust, then once it's in your name and your husband's name, I would deed it directly into your asset protection trust. If you have just a basic revocable trust that avoids probate and controls the distribution upon death, then what I would do is I would do what's called a ladybird deed, which is a special type of deed that says it's in your name while you're alive. But then if you were to pass away and your husband passes away, then it goes into the trust and avoids probate and follows the distribution plan of the trust. So that wasn't part of your question, but Amy, I think that should be the next step. So do a deed from the trust to your name, do a deed from the trust to yours and your brother's name. Do a deed from you and your brother's name to you and your husband's name. And then from there, I would just engage in your own estate planning, whether you deed it directly to the trust or you do the ladybird deed that says it's in your name while you're alive. And then if you were to pass away, it avoids probate and follows the distribution plan of your own trust. So, Amy, I hope that was helpful. Again, at least 2 steps, maybe 3 steps in that situation. And before we get to the last question, again, we do these answer listener questions every week. So if you do have a question, maybe something I talked about this week on tax planning and it wasn't clear, or if you have a question that you want answered, shoot an email to askchris@thechrisberryshow.com or give us a call at 810-355-2584. Now for the last question, Am I safe to continue investing in Warren Buffett's 90% stock, 10% bond recommendation, or should I play it safe and become more conservative as I near retirement? And this is from Jonathan. And he writes, I'm 53, I have $1.1 million in my IRAs, another $500,000 in various funds and stocks. Well, so Jonathan, we all agree Warren Buffett's a great man, a great investor. But one problem I have with is just general guidance that doesn't apply to your specific situation. So that might be a great recommendation for Warren Buffett or what he'd do, but everyone's situation is a little bit different. One of the things we learned is answer every question with it depends, because it depends on a lot of different factors. And that's why if you listen to the show last week, we subscribed to that bucket plan, which really takes into account your own individual plan to create a financial plan that's individualized for your own situation. Taking into account your own income streams, taking into account your volatility, taking into account how you plan on using your money as you near retirement and then in retirement, and protecting against that sequence of returns risk. So if you're asking a 90% equities, 10% bond recommendation, that might be a little bit aggressive as you're nearing retirement, but I wouldn't be able to give you any advice until we know how much volatility you're willing to take on, because every family is different, every investor is a little bit different. So that's the problem I have with Susie Orman's and Dave Ramsey's with just that general guidance. There's always more to it. So I hope that was helpful, Jonathan. So next week, please join us as we talk about elder abuse and scams that we're seeing. It's going to be a good one. I've seen it with my own eyes, so we're going to learn how to protect ourselves from that. That's going to be next week on The Chris Berry Show. Have a great week. I'll see you next Sunday, 2 p.m. Every Sunday. Take care.
Learn more about Chris Berry and the Elder Care Firm by visiting online at MichiganEstatePlanning.com. That's MichiganEstatePlanning.com. You can also call Chris Berry at 888-390-4360. 888-390-4360. This program content reflects the opinions of Chris Berry and his guests, not the Elder Care Firm, Prosperity Capital Advisors, or the C.J. Berry Group, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal or tax strategy. There's no guarantee that the strategist's statements, opinions, or forecast provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses, which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs. This program is furnished by the Elder Care Firm.
If you or a loved one is facing long-term care costs, make sure you talk with certified elder law attorney Chris Berry from the Elder Care Firm, like Sherry Skelton and her family did from Fenton.
It's really scary when you know that your parent deserves a certain quality of life and you're not able to afford it unless you get these benefits. And that was the place where we were at. We were like, we couldn't take care of her. We all had families of our own. We all worked. And of course, we wanted her in the best possible place that we could afford. And none of that would have been, we never would have been able to do that if it wasn't for them. I always recommend Chris. And I always tell people when they have any questions, I just say, you know what, you need to contact this guy because I can't even begin to tell you what he did for my family.
Hello, I'm attorney Chris Berry. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Protect your assets from probate, long-term care costs, the IRS, and get the governmental benefits you deserve. Visit theeldercarefirm.com today or call 810-214-3800.